Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 3rd of September. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about how we're turning a little bit more cautious on global equities. So now you may ask, would this be beneficial for bonds, which is often seen as the flip side to equities? Well, the answer is yes and no. So historically, bonds, especially the developed market quality bonds, they have been a consistent performer in the past easing cycles. But this time around, we believe much of the cuts have been priced in already. So if you look at the majority of the past easing cycle, most of the bond asset classes, including emerging market bonds and developed market high-yield bonds, they gave positive returns 6 to 7 months after the first rate cut, before paths start to diverge as growth slowdown becomes a bit more apparent and they weigh on the riskier bonds later in the easing cycles. Now, if you look at the episodes of soft landing in 1987, 1995, and 1998, the bonds performed well, with riskier bonds such as EM dollar and DM high-yield bonds in particular benefiting from US economic resilience. Now, high-quality bonds can also perform well in soft landing episodes, although in the 1998 cycle, gains in high-quality bonds did pause as the cycle continued with little sign of further economic deterioration. Now, this time around, market expectations for easing are significantly higher, and that's at about 140 basis points versus what they were back in the past rate-cutting cycles. So even if a soft landing were to occur, as we anticipate, this could result in more limited gains in bonds relative to the past cycles. Now, based on the current level of rate cut expectations 1 year out, the only comparable historical episode was during the global financial crisis, when markets were pricing in as much as 185 basis points of cuts in response to the global downturn. So for the Fed to surpass market expectations, growth will likely need to deteriorate much more significantly from here. Now, despite this backdrop though, there remains value in maintaining some bond exposure, particularly to high-quality bonds, given reasonably attractive yields and not insignificant risk of a hard landing, which can result in much lower bond yields and thus higher bond prices versus today's levels. So therefore, we maintain a core allocation for bonds over a 12-month horizon. Moreover, there are pockets of opportunities out there. We've identified the very long end of the US government bond yield curve underperforming shorter tenures year to date. And we believe the 20-plus year US government bonds offer relative value and room to catch up as the Fed rate cut cycle kicks off. Shallower than expected rate cuts are a risk. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.